Welcome back to Smart Stock Sam, the channel where we cut through the noise and follow the data. Before we dive in, I need to ask you something that might sound crazy right now. What if the worst week SoFi has had in months is secretly the best thing that could have happened to long-term investors? What if the exact moment retail traders are hitting the sell button is the moment the smartest money on the planet is quietly loading up? Because here is what I am seeing in the data right now. The stock price and the actual business fundamentals are moving in completely opposite directions, and that kind of divergence almost never lasts. This week, we are doing a full reality check on SoFi, examining whether this stock is actually coiling up for an explosive move higher, or whether the floor is genuinely about to fall out from under it. We will cover exactly where the smart money is positioned, what the technicals are telling us heading into the week of March 16th through the 20th, and the one upcoming catalyst that could either light this powder keg or snuff it out entirely. Stay locked in, because the numbers we are about to walk through are going to completely change the way you are looking at this setup. Here is the high-level summary before we go deep. We just watched SoFi breach $17.88, a price level so many analysts called the Noto Floor because it represents the average entry price of CEO Anthony Noto's own personal million-dollar insider purchases. On the surface, that breach looks alarming. It looks like a breakdown, but the moment you look past the price action and into the fundamentals, the picture shifts dramatically. We are talking about 9 consecutive quarters of GAAP profitability and a PEG ratio of 0.64. For anyone unfamiliar, a PEG ratio below 1.0 is the textbook definition of a stock that is deeply undervalued relative to its earnings growth. And while retail sentiment cratered, firms like Citadel and JPMorgan were not panicking, they were buying. Nearly 38 million shares were added to institutional positions. These firms are not focused on this week's red candles. They are focused on the March 17th and 18th FOMC meeting, where 134 million shorted shares and a massive $20 call wall are sitting like a loaded trigger. But before we talk about what happens next, we need to be honest about what happened last week, because Smart Stock Sam does not run from accountability. Our technical targets heading into last week were precise. We were looking for a rally high in the $19.80 to $20.30 range. The actual high came in at $19.02 on March 10th, close but capped. More importantly, we expected $17.88 to hold as a floor. Instead, intense external pressure drove a breach all the way down to a weekly low of $17.53. Now, does that mean the thesis is broken? Absolutely not. It means the market ran into a force bigger than SoFi's individual story. It means we have to understand what caused the deviation, because the cause changes everything about what comes next. And that cause has a name: macro gravity. Think of it as an invisible weight pressing down on every equity in the market, regardless of how well the underlying business is actually performing. Last week, we got hit with what I can only describe as a toxic trifecta of macro pressure. First, stagflation fears exploded after 92,000 job losses were reported for February. Second, an energy shock sent Brent crude surging past $100 per barrel, a massive headwind specifically for growth equities and fintech names. And the final blow was a brutal GDP revision. U.S. fourth quarter growth was slashed from 1.4% all the way down to just 0.7%. When the economy slows that sharply and energy costs spike that violently, the broader indices drag every single stock down with them, even the ones with exceptional internal metrics. SoFi got caught in that gravitational pull. But gravity does not last forever. And here is where things get really interesting. On one side of the scale, you have the macro reality: slowing growth, rising energy costs, and a fintech sector that is under contraction pressure. On the other side, you have SoFi's internal engine running at full throttle, record operational execution, strategic moats being expanded, and perhaps most importantly, institutions in a state of what I would call massive deliberate accumulation. This divergence, where the stock is pricing in fear while the business is delivering on its engine, is exactly the kind of setup that creates a strong buy opportunity for investors who are paying attention. The market is handing you a discount that is not justified by the company's performance. The question is, will you take it, or will you let the fear make that decision for you? Let's talk about the actual numbers, because this is where the deep value argument becomes impossible to ignore. SoFi's revenue is growing at 39.6% year over year. Stop for a second and let that sink in. Legacy banks, your JPMorgans, your Wells Fargos, are growing at a fraction of that rate. And SoFi is not just growing fast, it is growing profitably, delivering 9 straight quarters of GAAP profitability across completely different market environments. But the number that should make every value investor do a double take is that 0.64 PEG ratio. Growth stocks of this caliber typically trade at a premium to earnings. SoFi is trading at a discount. You are getting high-velocity growth at a price usually reserved for a slow-moving utility. That combination almost never exists, and when it does not last. Now, let's talk about why institutions specifically are so aggressively accumulating. It comes down to 2 structural pillars that are fundamentally transforming what SoFi is as a company. The first is the regulated stablecoin ecosystem. With the launch of SoFi USD, a bank-backed stablecoin, alongside strategic partnerships with MasterCard and BitGo, SoFi is tapping into a $1 trillion addressable market with 24/7 instant settlement capability. Legacy banks are years behind on this. The second pillar is Galileo, SoFi's proprietary technology infrastructure. By vertically integrating their entire technology stack and eliminating third-party dependencies, SoFi is achieving a level of operational efficiency that competitors literally cannot replicate. They own the pipes the money flows through, which means as volume scales, margins scale with it. These are not short-term catalysts. These are decade-long structural advantages. And if you want proof that the big money agrees, look at what they did with their own capital last week. Citadel advisors, one of the most sophisticated institutional traders on the planet, increased their stake by a staggering 234%. JPMorgan added over 17 million shares, representing a 37% increase in their position. But the signal that gave me the most confidence? The Swiss National Bank, a foreign sovereign institution, made a strategic entry, acquiring 1,196,000 shares. When a central bank from another country enters a position in a US fintech company, that is not a trade. That is a long-term conviction bet on where the global financial system is heading. These players are not reading a 5-minute chart. They are betting on the structural future of finance itself. So, where does the earnings story go from here? Analysts are projecting 26 cents earnings per share for the current fiscal year. On its own, that sounds modest. But here is what that number actually means. It represents a 60% increase from SoFi's 2025 performance baseline, 60% earnings growth. That is the vertical integration margin expansion we just talked about finally showing up in the bottom line. The market has not fully priced in this earnings trajectory yet. And that gap between what the company is earning and what the stock currently reflects is where the opportunity lives. And you know what? We may have already seen the first sign of the tide turning. On March 12th, the macro pressure was heavy and SoFi closed at $17.70. But then something remarkable happened on March 13th. The S&P 500 finished the day down 0.61%. The Nasdaq dropped nearly 1 full percent. And SoFi? SoFi finished the day green, up 0.34%. That is not a coincidence. That is relative strength. It tells us that buyers are actively stepping in near that $17.53 weekly low, and a new technical base is forming right under the surface. Now, let's map out the actual technical landscape for the week of March 16th through the 20th. Because having a plan is what separates investors from gamblers. The green zone, your immediate support, sits between $16.95 and $17 even. This aligns precisely with the 0.618 Fibonacci retracement level and represents your absolute downside floor if macro pressure intensifies. The blue zone, the aggressive entry range for anyone looking to add or initiate a position, runs from $17.50 to $17.70. And then there's the critical resistance we need to watch, the 50-day moving average sitting at $18.37. Reclaiming that level is the switch that flips the momentum indicators from sell to neutral. Break through that, and the psychological ceiling at $19 becomes the immediate target, with a total upside range of $18.80 to $19.50 in play for the week. But here is the variable that could turn a steady grind higher into something much more violent: the $20 call wall. Right now, there are nearly 190,000 open interest contracts concentrated at the $20 strike for the March 20th expiration. This is the gamma squeeze setup. As the stock price approaches that $20 level, market makers who sold those call contracts are forced to buy underlying shares to hedge their exposure. And the mechanic is self-reinforcing. The higher the price climbs, the more shares they are forced to purchase, which pushes the price even higher. Could we see a gamma-driven move that skips right over $19 and goes straight to $20? It sounds almost too good to be true, but the open interest data says it is absolutely on the table. And the shorts are not in a comfortable position either. There are 134 million shares currently held short, representing over 10% of the entire float. With a days to cover ratio of 2.5, these positions are highly overextended near the $17.50 lows. Any sudden shift in macro sentiment does not give them time to exit gracefully. A forced covering event, where shorts scramble to buy back shares simultaneously, has the potential to accelerate this stock violently upward toward a $22 gap fill target that has been sitting untouched on the chart. And the spark that could trigger all of it? The Federal Reserve's rate decision on March 17th and 18th. This is the macro release valve for everything we have talked about today. If the Fed comes in hawkish, if they signal ongoing alarm about oil prices and job losses, then macro gravity continues pressing SoFi toward that $16.95 floor, and we manage accordingly. But if we get the other path, dovish clarity or oil pulling back, or any signal that the Fed sees the growth slowdown as a reason to pause, that macro weight lifts instantly. And when it lifts, the internal engine, the institutional accumulation, and those 134 million overextended short positions become the dominant force in this stock. Before I give you the final verdict, I want to be transparent with you. Nothing in this video is financial advice. I am not a licensed financial advisor. Everything discussed here is for educational and informational purposes only. All investing involves risk, and you can lose money. Please do your own research and consult a qualified financial professional before making any investment decisions. The analysis presented here reflects my interpretation of publicly available data and does not guarantee any specific outcome. With that said, the trade setup is clear. Smart Stock Sam is maintaining a strong buy rating on SoFi. The breach of the Noto Floor was a macro-driven anomaly, not a fundamental failure. We have three distinct forces coiling simultaneously: deep value fundamentals anchored by that 0.64 peg, smart money conviction with 38 million institutional shares added, and a technical powder keg built from the $20 call wall and 134 million shorted shares. The optimal entry zone is between $17.50 and $17.70. The immediate price target range is $18.80 to $19.50, with a $22 gap fill scenario becoming realistic if the FOMC delivers the catalyst this setup deserves. SoFi is a coiled spring. The question is not whether it moves, it is whether you are positioned when it does. Now, here is the question I want you to answer in the comments right now. Do you think the Fed has the conviction to deliver a dovish signal this week? Or will they let macro fear continue to dominate the tape? Drop your call below. If you found this breakdown valuable, hit that like button. It genuinely helps this video reach more investors who need to see this data. Subscribe to Smart Stock Sam so you never miss a price target update. And if you want to help this video climb the ranks and get discovered, share it with one person in your network who is watching SoFi right now. I will see you in the next one.